Well, hey there. Thanks for joining this episode of the Union Podcast. I'm Scott King, and with me today is Sam Abadir. Hey, Sam, how are you doing?
I'm well. Good to see you.
Glad you're here. Glad to hear. We are going to talk about third-party risk management, right, Sam?
We are. It's one of my favorite topics to talk about.
I know. I'm glad it's one of your favorites. And
for anybody watching, it truly is one of my favorite things to talk about.
It truly is. He talks about it all the time. And he's always educating us, and we're going to educate you guys. There was a new guidance or something, Sam, that the OCC put out, and the OCC is, if I recall correctly, the Office of the Comptroller of the Currency, issued some guidance on third-party risk relationships and risk management. Can you just begin with explain what that is and maybe their intention?
Sure. Well, the OCC has actually been kind of the leading thought leader within the regulatory agency, especially within financial services, around third-party risk management. They put out issues in 2013 and 2017. And other regulatory agencies followed suit. So the Federal Reserve Board has had their third-party risk management program. The FDIC has had theirs. You can see there's lots and lots of overlap. And Scott, the news that you're talking about is actually quite revolutionary, because what happened was the OCC got together with the FDIC and the FRB and said, hey, instead of having three similar parallel things that are kind of confusing to everybody, let's just have one set of regulations. And they simplified and agreed upon using the OCC's regulations. So there's a new note out, and it's, if you want to look it up, I believe it's OCC 2023-19. But you can go through and look at how they have created one singular set of guidance for third-party risk management. And it's a pretty comprehensive framework. You can see that it's actually a real framework. You can see the intent of what's going on, and it actually has some requirements and things like that in there. So if you're new or you're old in third-party risk management, you'll completely understand what's going on.
So if there were several guidelines, I'm assuming that there were some similarities. As risk professionals, did they follow one or the other? And then if so, like, which one was the most popular?
It's a good question. It depends on the size of bank you were. Some people had to follow FDIC, some people had to follow FRB, some people had to follow OCC. But as you get bigger, or as you get smaller, or as consolidation happens and things like that, there became a lot of confusion. I'm sure those were some of the drivers. There's probably some other drivers in there too for simplifying it, but you didn't have to. You pick the ones that the regulators that knocked on your door came and had. So and we're testing you on or examining you on.
Okay, well, hopefully you knew who was coming, right? To your
fingers
door.
Crossed.
So does it make it simpler? Like if all of a sudden there were three and now we're going to combine it, I would assume that they're trying to make it easier, right? Because risk management only gets harder and harder as suppliers get more niche-y and we get more suppliers and we're more fragmented. Hopefully it makes it simpler.
We do absolutely have to commend the government and the banking regulators for trying to make it simpler, but it didn't make it simple, right? So there's always been lots of challenges and lots of weaknesses in third-party risk management programs. I remember meeting this guy one time, and he wrote. He actually wrote a bunch of articles, and his name's Tony De Silva. He wrote one, and I posted a link to it on our website. But he's talking about, and by the way, he's an expert because he's actually one of those regulator guys. He goes through and he's been a subject matter expert at the Federal Reserve Bank, I think from Atlanta for years. And he has seen tons and tons of banks and all the challenges they have. And simplifying the regulation or combining three regulations into one regulation isn't going to solve any of those weaknesses, right? So, those weaknesses include things like insufficient oversight by the board. And there's really insufficient oversight by the board because we're not getting the right data from the third-party risk programs. So they're not getting enough information. There's not enough formal policies and formal results and history that's being documented to report to them. Third-party risk management, a lot of people think it's the job of the third-party risk manager, but third parties are used throughout your entire organization. And so whenever you see weakness in third-party risk, you often see weakness throughout the rest of the bank. Business processes might not be defined properly or defined well, so the third party might flub them up. Somewhere in between, you have to write a contract with those guys, and if the contracts aren't written well, then maybe the whole intention or maybe the important nuances of what you need to get done in your business contract or your business process aren't being accomplished by your third party because they were never put there.
So with that, Sam, you said if the third party risk management program maybe wasn't as good as it could be, you're assuming that at the same organization, other processes maybe have the same behavior, right? So like maybe they just lack
correlation to
oversight
that.
of all processes. Is that what you mean?
It's a strong correlation to
Yeah.
that. When you see really well-run third-party risk management programs, generally means you also have very well-run programs, risk management programs internally too.
Okay.
Mm-hmm. Yeah. And, so that means you're writing good contracts. That means you have well-documented processes. That means that you have the right links between cybersecurity and the business processes themselves. And frankly, that's difficult, doesn't exist quite a bit. And what that results in is very difficult third-party risk assessments. And when you have difficult third-party risk assessments, you're asking questions that might not be relevant. Vendors don't want to answer the questions. And you get these people who are doing the job that find the job not nearly as satisfying as what they hoped, right? What they're hoping to do is help the institution, help the bank. Everybody goes into risk management for really good intentions, but a lot of times it ends up just being reading documents and filling out spreadsheets and filling out GRC tools and things like that. So you find a lot of people who jump ship, and you have very unqualified people oftentimes running third-party risk management programs. And that doesn't happen. I know we're talking about the OCC and banks, but that happens in every industry.
But so, I mean, if there's all these documents and spreadsheets, and you mentioned GRC tools, weren't the GRC tools supposed to solve this problem? Like, you create your process and the supplier, answers all of your questions. I mean, I understand that there's, that's kind of slow process, right? Because, a vendor may or may not react in time. But, weren't they supposed to do that? Or they're supposed to fix that?
The GRC tools themselves are frankly very good, and they solve an awful lot of problems, but they don't solve all of the problems. And let's just talk about third-party risk as one of those, right? So if you are an enterprise or you're a bank, the average enterprise, like enormous company, has 5,000 vendors. The bank probably has a couple hundred, maybe 1,000 vendors. Depends on, JP Morgan Chase and some of those huge ones have 5,000, 10,000 vendors easy. I have a friend who was a chief information security officer for a company that every bank in the country worked with, right? It's a great business to be in. They have literally every bank as a customer. And which meant that they got risk assessments from all 5,000 banks in the country. And that's a lot of risk assessments to complete. And if you ever, Scott, have filled out one of these risk assessments, they are between 100 and 800 questions long. So it's not a simple task. It's not something you can just do over your lunch break or anything like that. It takes a dedicated effort. And for an experienced person, filling out one of the standard security assessments probably takes about 2 days, 3 days. Now,
2 or 3 days to fill out 800 questions?
Yeah, it takes a long time.
Okay.
And a lot of times the person who's actually getting the risk assessment is probably the account manager, right? The account manager often doesn't have that level of knowledge to ask about business continuity and incident response and things like that. A couple will do, but for the most part, they don't. They have to reach out to others. The chief information and security officer is a common person to answer these types of questions. And if you take 3 days times 5,000 assessments, that is 1,500 days. They can't do it. So this is one of the problems. The GRC tools are really awesome. They will send the assessment to somebody, and that person who has to answer the assessment can go into a secure portal and answer all the questions in the portal, and attach their documents for validation, things like that. But that's where the problem starts, because that chief information security, the portal operator, can't answer 5,000 questions in 800 questions in 5,000 portals. They can't do it, and it's quite common to just give your customer something like a customer assurance packet, right? And it might have a lot of your information security stuff in there. It might have things such as your SOC 2 report. It might have your ISO 27001, a statement of awareness or statement of assessment. It might have other types of independent things. It might actually have an old assessment in there, right? So I fill it out once and I'll just give it to everybody. A lot of these standardized assessments change every year. I would expect in 2024, we're going to see the standardized assessments to have all sorts of stuff about AI in them. But if I'm still sending you what I wrote in 2017, that's not fully comprehensive. It's not getting all your answers. So this is where this type of stuff breaks down. If you're the risk manager, you still have to report to the board. You still have to do this, which means now you're opening up all these documents, you're reading them, and you're looking to answer those questions yourself. So we've just shifted the problem away from the vendor to the risk manager. It's not uncommon to ask a third-party risk manager, how many companies are under your management? And they might say, oh, I have about 5,000 vendors or 2,000 vendors. And then you might ask them, how many risk assessments do you get done in a year? And they'll laugh and they'll say 60, 80, 100, right? So it's a big gap. And then you might ask, well, how do you decide which ones to choose? And they say, well, I choose my riskiest ones because that's all I can do. Without assessing them, how do you know that they're your riskiest?
Well, yeah, ones? I know the risk. Know the most risky of the 60, but not of the greater number, right? Mm-hmm. So
exactly.
What I mean, what are they exposing themselves to by doing it that way, right? So if there's a vendor out there and it has, it's high on the risk scale, but they're not assessing that vendor through one of the organized assessments, like the one of the 60, right? Because they can't get to it. Like what happens? Like what's like worst case?
Well, a more common scenario is you look at those vendors that you have and you say, these are the ones that are going to take some of my most important information, and you assess those. Generally, those are the ones that have the best controls in place and are managing the risk the best. It's that next tier down which you weren't expecting to have issues with. So classic example is, if you remember, in the mid 2010s, Home Depot, maybe 2013, Home Depot was breached, and they lost all their credit cards, right? All the credit card information. I personally had 2 credit cards that were compromised because of that. The root cause of that wasn't their credit card processor. The root cause of that wasn't their health insurance company or their order taking system or anybody else like that has sensitive data attached to it. The root cause was an HVAC vendor, right? And you might think, oh, an HVAC vendor isn't supposed to be touching, my credit card information. So if you're only going to, assess X percent, that's probably not making the cut. But the HVAC vendor had access to the network, and the network is where they made where the bad guys made their entry point and stole all the credit card information. So that's the bigger thing that you have to worry about. without doing your full risk assessment, you're not going to understand
Yeah.
who's actually presenting you the most risk, not
Yeah,
the most residual risk.
that's interesting because you may not realize that maybe the HVAC vendor, I don't recall that one because that was quite some time ago, but maybe as the smart devices came online, they were doing remote, HVAC management, maybe needed the network. They attached to the network, and the risk manager probably didn't put that together, which may happen with AI, right? If you don't realize that your vendors are going to be putting different types of AI, either obviously from other parties, right? So it's a third party risk to them, like supply chain risk of an open
Fourth
source
party,
model
yep.
or thing like that. Yeah, if you don't realize that, then you're really going to be into trouble because that is going to explode faster than someone needing network access. So if there's too much work and there's too little resources, people are going to look for AI to do this, right? AI to do something in this process. Where do you foresee the process is being improved by either, automation and then AI on top of that automation? What is that going to look like? And give us kind of a time frame, because I've seen Gen AI actually fill out documents from other documents. Is that the kind of thing that we're going to see, or what is it going to be like?
When you go out to any of those generative AI tools like ChatGPT or Copilot or anything like that, that's really hard to you can actually, it's really hard to control where the answers are coming from, and then it's very laborious to actually ask all the questions. So this is actually one of the neat things that we're going to be seeing, and it's available today. But if you can combine process automation as well as AI, we can do an amazing amount of things within third-party risk and risk in general. But think about this in third-party risk. And now let's start here. Think about this in third-party risk. Instead of asking your vendor to fill out the assessment, what if you just ask them? And by the way, when you ask them to do that and you say, hey, I need it back in a week or 2 weeks, that causes a lot of stress and a lot of tension between the business and the vendor. And the vendors don't want to do that. They're the customers. They want you to they want to be good. They want to be good customers, right? But at some point they're going to tell you to pound sand if it's going to be too much of a burden on them. What if you could remove all of that by just saying, hey, send me your customer assurance packet. Don't even worry about anything else. Just send me your customer assurance packet, and my AI tool is going to complete the assessment for you. I'll give it back to you so you can double check it and even use it as you need. But I'll complete the assessment by yourself. And that's going to improve vendor relationships and make that so much easier, because AI will be able to cut that time down from days to literally 15 minutes. I've actually seen this live, and it can do it in like 15 minutes. So that is a tremendous scaling operation, and it could be run 24 hours a day, and it can be run in parallel. So we're really going to be able to complete those assessments. But if I take a step back, the goal isn't to complete assessments, right? We've been talking about third-party risk assessments, but the goal actually isn't to do that. You complete those assessments so you can see where the answers deviate from what your organization deems to be acceptable. And that's where risk lives. So now I can actually very quickly use those same tools to not only complete the assessments, but surface the risks or the threats and make people aware of them so that they can actually have risk-informed or create risk-informed decisions. So whether that means reaching out to them on a tool like Microsoft Teams and saying, hey, your favorite vendor is doing X, Y, and Z. Or whether it's putting it into your ticketing system or your finding system and creating something that is traceable and auditable. All those things are completely possible when you combine not when you use just AI, but use AI as well as process automation that can, link into your systems, is truly going to be the next evolution in risk management, and really make things more efficient, effective, agile, and provide even better resilience. So I can expand that thought for a long time, but I think that anybody else who is as excited about it as me can kind of see all the next steps that you can add on to be a better risk manager and be more aware of the risk, so you can go into things eyes wide open.
So if I'm a risk manager, like based on your explanation, I immediately have two concerns, right? The AI thing is going to take my job because you said it's going to fill it out automatically. And then if it doesn't, like how accurate is it? Or because that's the number one thing is people are concerned about the accuracy. Well, I don't want this thing going haywire and just filling out like crazy stuff or hallucinating. How do we handle that, right? Because I've done it the old-fashioned way. I filled out spreadsheets, and now I've got AI helping me. Like I don't know where I fit.
I heard something recently, and it really resonated. You're not going to lose your job to AI. You just won't. You're going to lose your job to somebody who uses AI. So think about that, right? AI is here, and it's only here to help. It's going to make things much, much more efficient. When you say you're going to lose your job to AI, if I go back to the stories I told earlier, the risk managers are only doing 50 out of 1,000 vendors, right? In order to do all 1,000, they would have to hire 20 or 30 more people to do that. And they're just not going to spend, banks, any organization just isn't going to spend that money today. Your job isn't going away. And remember, this is all about risk awareness, not risk decisions. The risk manager, and no company has enough risk managers. No company has enough people in risk management, I should say it that way. They're not going to get rid of them. What's going to happen is those jobs are going to, AI is going to remove the drudgery of those jobs and really bring the glamour and the glory of those jobs right up. You're going to be able to communicate with business leaders in real time and in context of what it is that they do, because you're using AI and process automation in concert with your GRC tools. This isn't going to replace your GRC tools. It's not going to replace your ticketing tools. It's just going to supercharge all of them, and allow the risk managers to provide insight and value versus typing something here and then retyping it here and occasionally sending off a result and being tired and bored and quitting their job. So I will fight to the end on risk managers losing their jobs because of this. This is something that's just going to empower them to do their job significantly better.
All right. Well, you heard it here. If any risk manager is going to lose their job from this, Sam will fight for you. You sound like some type of lawyer or something, right? That we have down here in Dallas. But to sum it up, so if I'm a risk manager and I'm looking around at the processes, there's too much work. There's AI. I don't know which one works. There's automation. I don't know how it fits with my GRC tools. What are three things that you can advise them to do if they're listening to this podcast?
Look for a process AI-enabled process automation tool platform. One that is platform and tool agnostic, right? And you can tie it into any tool, any process that you have. So an agnostic platform is probably the biggest thing that you can do. So that would be one. Two, we've seen so many advances in AI, and I don't think a lot of people have thought about this, Scott, but a lot of people think AI is AI is AI. Well, I remember in the 1990s, a lot of people quickly thought ERP was ERP, and then they realized ERPs do things differently, or enterprise resource planning tools do things differently. And then you had people who swore that Bond was better than SAP, better than Siebel, and all those different things. In the end, a couple survived and many didn't because some were really great and some were not. You're going to find the same thing with generative AI. And you're going to find that if ChatGPT is your favorite one today, it might be Microsoft's tomorrow. It might be Amazon's the day after. It could be anything because these things are advancing so quickly. The reason I'm talking about this is if you get yourself one of those those AI-enabled process orchestration platforms, make sure you're not locked into somebody's AI. I've seen this explosion of AI within tools, right? So, this application has AI built into it, and this one has AI built into it, and this one has AI built into it. What happens when that's not the best of breed anymore? How hard is it to be able to swap out all of the ones from all the different application vendors that you get? That might actually be difficult and or impossible.
There's a lot.
If you get yourself an AI platform, find ones that you can swap them in and out or use multiple at the same time, right? If you can get a banking specific AI to ask mortgage specific questions, awesome. But for your operations clerk, maybe they can use a general one. So there's lots of different things you can do with that.
All right, super. Well, I appreciate it, Sam. We've gone a long way from OCC to not getting locked into an AI product. So I appreciate your insight and really glad to have you on.
Thanks. And as you can see, I'm super excited. Feel free to reach out to me. I can riff on this or chat on this or answer questions on this anytime.
All right. Thanks, everybody. Until next time.